10 years ago, you couldn't persuade me to ditch Delta for a flight on United. As a business traveler, loyalty mattered. Loyalty meant upgrades, the occasional champagne, and warm food. And then suddenly, United started to transform. Newer planes, better loyalty ladder, and more premium services. So I picked United for this analysis and as my carrier of choice. I wanted to analyze if my perception as a customer matched the financial data. And besides, as an engineer, I simply love planes. Let's address key findings first. We'll then dive into each portion of the analysis. At 6% profit margin, United is ahead of the industry average at 3%, but lags behind its pre-pandemic high. Debt to equity has been trending down post-pandemic, and United's continues to be a strong solvent corporation. Operational cash flows have trended up and are at 38% higher than even the pre-pandemic high. And yet, the stock is grossly undervalued as of April 22nd, 2025. Fuel efficiency and supply will be the primary challenges, but the recent tariffs are poised to potentially benefit United through aircraft order fulfillments and domestic operations that are exempt. Let's first assess profitability. United earned a respectable operating income, but the margin is flattening after initial post-pandemic rise. Payroll and fuel continue to dominate expenses in that order. Interestingly, salaries and airport landing fees have far outpaced fuel costs, as we'll see later in the video. While fuel expenses grew 31%, payroll grew 40%, and airport fees grew 50% post-pandemic. Similarly, regional airline contracts saw a 40% increase. This means while everybody expected fuel costs to be the profitability antagonist, United should actually be paying equal attention to its labor and partner contracts. But before we look at the operational details, let's look at solvency. United is in an asset-heavy industry with extreme operational expenses. Buying and running planes is an extremely capital-intensive activity. When I think about big transportation corporations, my mind immediately goes to the debt that's servicing this capital expenditure, and if those debt obligations will be met. United has come far from its bankruptcy days. Debt to equity and times earned ratio both show a clear positive trend, meaning debt obligations are being comfortably met post-pandemic. However, as discussed, the profit story and subsequently return on equity are facing some flatlining, but nothing of major concern. Similarly, liquidity is incredibly important when running a large-scale operation such as the one United runs. To put into perspective, in 2024, United transported as many people in the US as the entirety of the working age population of the US. Cash flows from operating activity has shown a positive uptrend. I, as a business traveler, have personally experienced the post-pandemic travel uptick and feel optimistic about how many other business travelers I see. This cash flow also has been important in paying off pandemic era debt and maintaining a positive capex. This means United is using its cash to meet its debt obligations and reinvesting in what makes its operation successful, as we'll see in a couple slides. Lastly, I analyzed if investors agreed with my optimism. My financial model pointed to a high beta and thus more volatility compared to the rest of the market, but an undervalued stock. The PE ratio and stock price are at a reasonable level for a legacy carrier with an enterprise value multiple of 4.54. My calculations show that United stock will be fairly valued at around $150. However, the cyclical nature might not make it the best long-term buy and hold, and financial analysts on Wall Street Journal and Bloomberg agree. Now, I found that one of the most important operational ways you can measure an airline's efficiency is the fuel cost per available seat mile, called fuel CASM. This essentially calculates how much it costs United to fly each seat, wherever it is headed, empty or filled. The interesting finding was that fuel consumption is back at 2019 level, and while fuel costs have increased 201%, the fuel cost to fly a seat has gone up 334%. This means inefficiency has outpaced increase in fuel prices and can be looked at from the perspective of fleet efficiency. Digging specifically into United's largest expenses, fuel and labor, which make up nearly half of all operating expenses. Number one, Boeing continues to be United's workhorse. Yes, some narrow body Airbus aircrafts are encroaching on 737 MAXs, but I still think United is betting on operational simplicity by buying American and sticking to one maker, while affording itself some flexibility for its busy hub to hub routes, where its aging Airbuses currently serve. United has also made some strides in optimizing its labor force. It has increased its flight operation resources, such as pilots, stewards, and maintenance crews, while cutting costs in the indirect labor categories, such as catering, while it continues to outsource to specialist corporations. To summarize it all, United is a profitable, solvent, and valuable legacy carrier. It's an undervalued stock. Yes, it's more volatile, but its cyclical nature gives it me more confidence for a short to medium term buy. In 2025, I'll be watching out for the trifecta of profitability headwinds: fuel prices, labor relations, and aircraft